Welcome to Yahoo Finance's special coverage of the July CPI report. I'm Julie Hyman. Numbers crossing the wire here and coming in largely in line with estimates, except for, I'm going to zero right in on the core year-over-year gain in consumer price index is 3.1%. That is a little higher than had been estimated, even though the headline number at 2.7% is actually 0.1% better than estimated. On a month-over-month basis, both the core and the headline number are in line with estimates, 0.2% for headline, 0.3% for core here. So let me just reiterate those numbers quickly. Year-over-year, core consumer level inflation in the U.S. rising 3.1% in July. That is 0.1% higher, i.e. hotter than had been estimated. The headline number for year-over-year, 2.7%. And then core inflation month over month rising 0.3% and headline inflation rising 0.2%. So those are the numbers overall, roughly in line with estimates here, with a couple of exceptions, obviously, when you look especially at that core year-over-year number. So it looks like that this is at least the highest increase that we've had since February in that year-over-year number, but we're going to keep digging into it. And for this report in particular, the individual components are going to be very, very important. That's where we're looking for any signs of inflation. In things like furniture, for example, did we see prices go up there? In things like appliances, did prices go up there? So we're going to keep looking through, I'm going to keep looking through the release here to see if we can dig into that and get some of the details on that. But headline, that number is a bit of a surprise. Let's talk more and dig into this inflation print now. Joining us to talk about it, Colin Martin, Schwab Center for Financial Research Fixed Income Strategist, Joe Brusuelas, RSM Chief Economist, Claudia Sahm, New Century Advisors Chief Economist. Thank you all for being here. Really appreciate it. So, Joe, I'm going to go to you first. What's your first blush reaction here to these numbers?
The core inflation, it came in a little hotter than expected. Moreover, the top line was flattered by a 1.1% decline in gasoline prices. So once we begin to dig deeper, what my sense is you're going to see goods inflations moved up and sticky service sector inflation. This is not conducive to arguments that there's no inflation via the trade channel. Basically, tariffs look like they're going to be all over this report.
And Claudia, this would seem to make the Fed's job a lot tougher.
The Fed's job is always tough, but it's certainly, we do see an inflation moving up, but in terms of the component, for them, if it's largely this tariff effect, if it's a goods effect, well, then that is something that there's a case to, quote unquote, look through it. Like that we're doing a one-time price adjustment and that'll cause rising inflation. But once that adjustment's done, it'll subside. The core services numbers did firm a little bit relative to last month, but really they've not seen the pickup. Like this is really coming, the lift is coming here from the tariff effects.
To your point, I'm noting in here the index for shelter was up 0.2%, and the statement saying that was the primary factor in the all items monthly index. So that perhaps, Claudia, particularly problematic here because we had been looking at that number moderating.
Right. Well, that actually a 0.2% for shelter, that's a good number. It's just shelter looms so large in the CPI that it's going to be a big contributor of inflation. So I think actually the shelter is doing what we had actually been looking for it to do for quite some time, which is kind of get back to a pace that is pre-pandemic. So I think that one actually here looks pretty good, but you're right. It's the big piece of inflation, and for regular people like the housing affordability, all of those issues that looms large, no question.
I'm also looking at some of the other commentary here. Indexes that increased over the month: medical care, airline fares, recreation, household furnishings, as we were looking for, and operations, household furnishings and operations, and used cars and trucks as well. It looks like the indexes for lodging away from home and communication were among the few major indexes that decreased in July. Colin, I want to get you here on this as well, and sort of how you're thinking about the effect on the rates market and the Fed also by extension.
Yeah, well, I think Joe and Claudia both made some really good points where we don't just want to look at those headline numbers. We want to look at the breakdown between goods and services. And because services really do make up a much larger share of inflation than goods do. So I agree with Claudia that we see the tariff impact in goods. But what is the impact of the softening labor market? What's that going to do to the service side of the equation? Because if you look at tariffs, that's trade policy. That's not really monetary policy. The Fed can't do too much there. But if we start to see more of that softness in services, in consumer spending, in the cyclical areas like that, I think the Fed might start to focus right there. But just looking at this number specifically, a core reading of 3.1% year over year. Obviously, there's so many numbers that we can point to. That's probably going to scare some officials because we have a number of officials who are talking about the weaker labor market right now and hinting that they might be open to cuts, some more explicitly, others more implicitly. But then there's others who are talking about the fact that inflation is still too high and frankly above target. So I'd say this probably does confuse the outlook a little bit, and we'll have to see how the PCE report and then the August CPE release comes out.
Right, and that's a good point because we all focus very heavily on the CPI report. It is important, but the gauge that the Fed focuses most heavily on is that PCE report, which we don't have yet. Joe, I can see you busily on your phone over there going through all of the numbers.
Right.
I know there's some stuff you want to
focus
on.
Core services ex energy was up 0.4%. That's 3.6 on a year ago basis. That's that sticky service sector inflation that we worried about. Moreover, you can see it in transportation services, which jumped 0.8%, as did medical care services. After increasing 0.6% last month, it's up 0.8%, and that's up 4.3 on a year ago basis. As I'm digging through the data just here on the first blush, guys, this is a meaningful increase in inflation. This is going to require a reconciliation of the Fed's dual mandate. You've got inflation rising, you've got job gains that are going to probably continue to be soft. This is going to create a real problem as we head towards the September meeting. Now, my sense is that when you get a challenge of the dual mandate, you get tension inside of it, you lean towards the period, or the portion that's furthest from its mandate, and that's inflation. So that means more patience, not the 80% chance of a rate cut that I saw in the federal funds market before we came on air this morning, right? Moreover, look, service inflation looks like it's just real sticky. And we're not really seeing the big pass-through from tariffs just yet. This is when we thought it would start. We've been able to see it in the granular data, apparel, toys, appliances, that sort of thing. And with the tariffs finally being set, the effective tariff is 17.6%. It's going to start showing up materially in October, November, December. This is not the easy layup that many market players and investors are portraying in terms of Fed rate cuts, whether it be 1, 2, 3, or whatever, right? So the detail is definitely in the data here this morning, and this is going to, I think, lead to a certain reassessment of those Fed rate cut probabilities.
Colin, what do you think? Did the market get ahead of itself in being so convinced that a rate cut in September is a done deal?
I don't want to say it got ahead of itself, but we always take those probabilities with a grain of salt because they can change so quickly. If we look at that implied probability that Joe's talking about, 80%, 90% for September. I mean, it was 40% before we got those July revisions. So I haven't seen what they're doing today and if they've adjusted a little bit, but we'll feel more confident in what the Fed will or won't do in September as we get closer. I mean, we're still more than a month out right now, and we have a lot of data coming in. I think it's really important to talk about that tension, though. And right now, you can make the case that inflation is further away from its target than the labor market is. If we start to see an increase in the unemployment rate, then that makes the case for the Fed maybe to act differently. But right now at 4.2%, it's still pretty close to what the Fed's kind of long-term outlook is.
Well, I gotta say, I just checked CME FedWatch, and it's still at about 82% for the moment. As you say, it fluctuates a lot over the course of the day. I am just waiting. I was just looking at Truth Social to see if the president had yet posted, Claudia, about this particular report, because I want to remind folks that this CPI report is not just labor data that comes out of the Bureau of Labor Statistics. It is the CPI data as well. And if the president doesn't like this number, I assume he is going to encourage people to disregard it, just like he did with the labor numbers.
Right. Well, the president has said multiple times in recent months that there is no inflation. So, he's been ignoring these data as they come out and, not concerned with it. I think a lot of it also goes with the market reaction to it, which I think, this is not a shocker like the jobs data was in terms of like, this is largely in line with what we were expecting to see in terms of inflation moving up. So, but yes, anytime, there's a lot of pressure on the Bureau of Labor Statistics from the president, and that's not a good sign in terms of, confidence in the data, its quality, and its, nonpartisan nature.
Well, let's move on to sort of zero in on that topic, because as we know, President Trump has now nominated E.J. Antoni. He's the chief economist currently at the conservative think tank, the Heritage Foundation. He's nominated him as the next commissioner of the Bureau of Labor Statistics. There's been a lot of commentary about that nomination, which still has to face the Senate to get through. So I want to bring you guys back in to talk about this as well. Claudia, let me get your take first. Given what we were just talking about, what does Antoni do? What does that nomination say? Does it get through? Does this guy have the chops to have that job?
Right. Well, the commissioner of the Bureau of Labor Statistics, that is the one political figure at the BLS. And that it's always the case. The president, nominates, the Senate confirms for that position. I think my biggest concern is the BLS is facing a lot of challenges. It is legitimately hard to run surveys, construct statistics, communicate them to the public, get them out in a timely manner. And frankly, this nominee just doesn't have a lot of experience and background in measurement and statistics. So I'll be really interested to hear what ideas he has on how to fix the problems that he's been a very vocal critic of. But that's, the BLS needs leadership and they need resources. So, if he's able to, get them those resources and provide that leadership, that'd be excellent. I don't see it in the record, but, we'll be surprised there too.
As we all know from probably daily experience in all of our jobs and lives, it's very easy to criticize. It's another thing to fix. Joe, what's your take on Antoni and what he might bring to the BLS?
When his Senate confirmation hearings happen, he should prepare for a withering set of criticism based on his credibility and his qualifications. We all know who E.J. is. We all see his work. And there's good doubt around his background and whether he's able to do this. Let me give you a sense of what's going on, like just with the inflation labor today, right? Obviously, there's been three big areas where the BLS has had to impute statistics because they're no longer collecting because investment in data collection is just not where it needs to be. BLS went back and did a 77-month study. What they found was that 18% of the months inflation was revised upward 1/10%, and in 14% of the months it was revised downward by 1/10%. You know what that's like? That's like watching the paint dry. If you're expecting major revisions in a granular time series like the consumer price index, you're not going to get it. And that's the problem, though, because
But in labor, the revisions have been much larger.
Sure, that's right. But we're using this, we can go to labor, right? Again, you need to invest more.
Right, in general, it does seem like there is an issue with data collection.
Because we haven't been investing in it, right? And the survey response rates following the pandemic, when lots of businesses were wiped out, have dropped to 60% or below. So the way to fix that is to invest in data collection, invest in new methodologies, and then ride with it. But I got to tell you, even in the big numbers, right? When you take a step back and look at the long period of the revisions, I mean, 99% of it's right? It just, right now, this has been so politicized.
Right.
Because we have a different president with a different point of view who just clearly is going to be uncomfortable with what the data implies about his own policies.
Colin, when it comes to what the market's going to cue off of, let's say Antoni gets confirmed, goes in there, does whatever he's going to do. I mean, the market doesn't have a lot of choice in terms of the data that it moves off of, unless we turn to alternative sources of data. I mean, how do you think this plays out?
Yeah, it's going to be difficult because a lot of the BLS data is really good. I mean, not just in the U.S., but globally, we rely on that data. And I think if there was a concern that it was being politicized or manipulated. I'm not saying that's going to happen, but I think there's probably concerns out there. There's a difference between updating methodologies and making sure we're getting the right data, but also making sure that it's not then politicized to get a certain outcome. I think that's going to be really important. There could be a push and pull between what we're getting from data if it does seem like the methodologies and the processes are changing. When we do have other private services, a lot of times though we kind of disregard those and focus on the government ones. I think ADP is a really good one. ADP comes out, up or down, people look at it, they don't really care too much because they say, well, we're going to look at the BLS data.
The real numbers coming out on Friday.
We're going to look at the real data. So I think trust is really important. I don't know how we solve for that if there's a lack of trust.
Yeah. Joe, real quick, then we got to go.
So we're going to be looking at private label data, ADP, Indeed, the Billion Prices Project over at Harvard. There's a plethora of data out there that we're all going to start turning to, and this is going to get different in a way I don't think those who make these criticisms have thought through.
Well, we'll see, won't we?
Yes,
All right,
we will.
Joe, Colin, Claudia, thank you so much. Really interesting conversation. Appreciate it. Coming up, we're going to have more on the July CPI report next on Yahoo Finance. You're watching special Yahoo Finance coverage of the July CPI report. We're going to send it on over to Jared Blickery now for a look at what's going on in the markets in reaction. Hey, Jared.
Hey, Julie, we are seeing a risk-on action here, and we'll get the Wi-Fi interactive dialed up behind me, and we can see a lot of green in the left, and that's what we're seeing in the U.S. right now. I'll start with the Dow, which is one of the underperformers. That's up 0.6%, and this reaction right here that you see going straight up, that was after the report. There's a little bit of a zigzag there, but the net reaction, the take-home is that it is up. And let's check out the NASDAQ, which is up a bit more. That is currently trading at the highs of the session, and also the Russell 2000, which is up even more, 1 1/3%, also trading at its highs right now. We can also take a look at what happened in the bond market, and we sent yields down across the curve. So what we're looking at here is the 13-week T-bill yield. That's a very short term. That's what tracks what the Fed might do, and so we saw that take a tick down. That's important because the 13-week T-bill does not move a lot intraday, but it will move off of these reports. Here's the 10-year T-note yield. You can see it was in positive territory, then it dropped a few basis points. Now it's about break even, and then finally the 30-year, which did drop into negative territory here, but it bounced back up. We'll have to see as this evolves during the day, but so far, not a big reaction. And I should add, too, that I've compiled statistics on which reports affect the market the most throughout this entire bull market going back to October. It has been CPI, 80 percentage points in the S&P 500 to the upside. 15 percentage points of that have come from the CPI reactions. So here we have the sector action behind me. What's in the background color, that's what happened yesterday. And what we want to focus on is what's in these little green rectangles. And almost everything is green right now, except for XLB in the bottom right. I was looking at the intraday pre-market charts on the Yahoo Finance site, and I did see a big tick up on the announcement in XLY, that's consumer discretionary, tech, financials here, XLF, and communication services, and also industrials, healthcare, utilities, energy, staples, real estate. Those also had small positive movements. And I want to take a look at the NASDAQ 100, and in those little green rectangles, we're seeing a lot, we're seeing a lot of green. NVIDIA up to, let's see, 76 basis points, pretty close to a record here, 182 and change. Microsoft up about 0.4%. And if we sort by performance, we only see a few stocks in the red this morning. In fact, less than 10, I would say. Marvell leading the way down only about 1.5%. We take a look at the Dow. We also see a lot of green in those rectangles, and just kind of sorting by performance here too, we only see Coca-Cola trading to the downside, and that's consumer staples. Not too worried about that. Sherwin-Williams and Home Depot, both consumer discretionary companies, both dealing with home improvement. Those are up the most, both of 1%. Nike following. Then we have Goldman Sachs, Amazon, Caterpillar. So an interesting mix of bullish sector reaction here. And I'm going to do one last thing. I'm going to go to our crypto page, and I'm going to show the reaction in Bitcoin and Ethereum. You can see Bitcoin down over the last 24 hours, although, let me put a 2-day view, we did have a small tick up, not a very big reaction on the announcement. And then I'll show Ethereum, which has just been on a tear the last few days. That is up almost close to its record highs, 4,500. So definitely be watching crypto today, but not a big movement off the report.
Jared, thank you very much. Interesting to see this reaction. We've been talking a lot about the categories in the July CPI report. Where did we see the most inflation? Where didn't we see it? Was it in services? Was it in goods? Our own Allie Canal is here with me to help go through all of that. So what are we seeing?
Right. Well, I think heading into this report, there was a big focus on core inflation, core goods, whether or not we're going to see that trickle through effect from tariffs. And on the core, year over year did come in a touch hotter than expected on a monthly basis, that 0.3%. That's the highest reading that we've seen in 6 months. So there are some sticky points here to bring out. But I think parsing through a lot of this early commentary, in a lot of ways, this was better than feared. And you can look under the hood at some of these categories to show that. Apparel prices, for example, rose just 0.1% after a 0.4% increase in the month of June. That being said, there were other categories like airline fares, for example, that rose 4% over the month after declining 0.1% in June. That's all a significant increase. We also saw increases in recreation, household furnishing, used cars, footwear. That jumped 1.4% month over month. That was the largest jump since April 2021. So we are seeing tariffs start to show up. However, it's not at the level that some on Wall Street initially feared. I think the whisper numbers were a lot stronger than what we saw today, which is why you're seeing this reaction in the stock market. And then on that headline number, we did see some softness there, better than expected, or roughly in line compared to what we saw in June. And that came as we saw food prices slow. We saw gas prices drop. So that's helping things, but shelter still remains sticky. And, again, a lot of economists have been saying that we're still early days when it comes to the full impact of these tariffs, and likely throughout August, throughout the fall, and even into 2026, we could see more of these prices tick higher. But right now, we're not seeing that at the level that maybe was initially feared.
Yeah, although there was some concern about the shelter index going up a little bit, so services inflation being a little bit stickier than had been anticipated. So that's what some of the economists we were speaking with were highlighting. What does all of this mean for the Fed? We always watch that Fed Watch tool from the CME very closely. And it looks like this hasn't really meaningfully changed the expectations for a cut in September.
No, if anything, the conviction is a little higher that we're going to be seeing a cut in December. Now, I will say immediately after this report, I checked, and we actually were a tad lower with the percentages. Now we're at 90%. So pretty much markets are expecting that rate cut in September. Overall, markets are pricing between 2 to 3 cuts by the end of the year. We have Jackson Hole coming up very soon, so Jerome Powell will probably leave some breadcrumbs about where he's thinking, and also the fact that we saw 2 dissents at the July meeting. I think that's leading to even more conviction that we will be seeing that cut.
Yes. Thanks so much, Allie. Appreciate it. We got much more Yahoo Finance ahead on Morning Brief. Stay with us. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the 3 things you need to know today. First up, U.S. stock futures moving higher following the July CPI report, which showed inflation coming in line with Wall Street's estimates, largely. Core inflation accelerating in July to 3.1% year over year. That is the strongest pace for that measure since the start of the year amid a pickup in services prices. Plus, President Trump tapping E.J. Antoni to lead the Bureau of Labor Statistics after firing the former head of the agency earlier this month. Antoni currently serves as the chief economist for the Heritage Foundation. It's a conservative think tank in Washington. He has been vocal about his concerns with BLS data and revisions. Antoni would succeed the BLS head, who was abruptly fired after the July payrolls report showed weak job growth and substantial downward revisions to the prior 2 months. The position subject to Senate confirmation. And President Trump is extending the U.S.-China trade truce for an additional 90 days, deferring a tariff hike set to take effect today. The de-escalation first took effect when the U.S. and China agreed to reduce tit-for-tat tariff hikes and to ease export restrictions on rare earths and certain technologies. But new reports say China is urging domestic firms to avoid using NVIDIA's H20 processors, complicating the chipmaker's attempts to recoup billions in lost China revenue, as well as the Trump administration's push to turn those sales into a government windfall. Let's get a check in on stock futures right now on the back of the CPI report, which did show that hotter number, 3.1% on a year-over-year basis on a core basis. But the market largely seeing this, interpreting this report as in line. We are seeing futures push higher this morning by about 0.5% across the board. We have been seeing bond yields come in and expectations for a Fed cut in September holding strong. Let's dig more now into our top stories of the day. That CPI data giving us a fresh read on inflation, plus President Trump nominating a new commissioner for the Bureau of Labor Statistics, and the trade truce with China extended for another 90 days. Joining me now, senior reporter Brooke DePalma live at the NASDAQ, Fed correspondent Jennifer Schonberger, and Ramzan Karmali live from our London studios. Brooke, I want to start with you with this market reaction that we are seeing, which is pretty interesting that seems to be pretty positive.
Yeah, pretty positive indeed after a roller coaster of emotions that investors have had leading into this CPI report, waiting to see if those tariffs that President Trump went in effectively over the course of the past months as deadlines shifted a bit. Now we're getting some initial reads on where we stand now. And hey, it's very much in line with expectations. That's what Art Hogan wrote in a note this morning. And that's what's easing some fears among investors right now, of course, based upon those extended deadlines. Some sources that we're hearing from this morning say that the increase from President Trump's tariffs could show up later on in a few months. But right now we're seeing stock futures rise ahead of the market open on this Tuesday. And what we're seeing is investors really move into consumer discretionary, move into tech, move into communications. And they're really sort of taking on this risk in hopes that we'll see a Fed cut in September, and really baking that in and moving their focus on those trade talks that are still undergoing, especially with China.
Jennifer, I want to turn to you here and the CPI, and sort of, I'm curious what stood out to you and sort of the implications then for the Federal Reserve.
Yeah, Julie, I mean, clearly markets think that a rate cut in September is a slam dunk, but you look at this morning's report, and I'm not sure that's the case because core CPI, which is what the Fed focuses on, clocked in hotter than expected, 3.1% versus 3%. Remember, this excludes the volatile food and energy prices. That was up from 2.9% in June. And what the Fed's really looking for is the impact of tariffs. And when I looked at this report, you see a little bit of it, right? When you look at furniture, maybe shoes, not so much in apparel, which is surprising to me. And so it's not super perceptible when you look at this report, but services looked sticky to me. And services has been a concern for the Fed. It looked like it was coming in line. It was looking good. So this report looks a little bit sticky to me. I don't think it's enough for the Fed to make a decision at this point. We are going to get more data before the September meeting, but it goes back to what I've said previously on our air, and I'll say it again, which is that the Fed is in a bit of a dilemma right now. They're looking at both the inflation side of their mandate, which looks sticky. They're looking at the job side of their mandate, which is looking weaker. I think that the determinant factor for the Fed is going to be the September jobs report, the one that we get, or I should say the August jobs report that comes out on September 5th. Because if that is weaker, then I think that could be the trigger for the Fed to cut. But if we see a rebound from what we saw this summer, given that inflation looks sticky right now, I still see a majority of the committee in sort of that wait and see mode.
Well, and I'm gonna throw a further wrench into it. What if you see a rebound but a lower revision for July, right? Because so then do you just assume that August number is going to be revised lower as well? So just to
Right, and that also speaks to how the data is collected, right? We know that there's sort of a 3-month course here where the BLS goes out to companies, and maybe companies aren't responding until month 3, and that's why we're seeing such large revisions in the data. And to your point, you know, that's what we've seen consistently all year. So we'll probably see another revision down.
Yeah, I mean,
do we go negative?
Right.
You
as Claudia Sam said, in the last half hour, the Fed's job is never easy, right? So, but maybe particularly not right now. Jen, I also want to talk to you about this new nominee for Commissioner of the Bureau of Labor Statistics, E.J. Antoni, who is at the Conservative Heritage Foundation. Economists don't seem thrilled about this pick, and there is this fear amongst economists that there will be sort of the partisan thumb on the scale when it comes to data.
Well, remember, Julie, like I said, I was watching whether the nominee is someone who is going to change the process of how data is collected and how things are done versus just simply putting somebody new in to oversee, as we saw with McIntyre prior. And with this new nominee, Antoni, he has been a longtime critic of the BLS and how the BLS collects data. And he said there are better ways to collect data and process and disseminate it. And that is going to be the next job of the BLS commissioner. So now that he is the nominee, we're going to have to see what he's going to do. Now, he has to be confirmed by the Senate. So the Senate is going to be peppering him with questions, I'm sure Democrats more than Republicans, about what he's going to do, how he could change the process of data collection. Certainly there are improvements that could be made, but the question is, could this be slanted in a way that would be partisan to make the numbers look better, which is what investors have been concerned about, and questions over how could he handle a report that perhaps the president doesn't like.
Right. Good questions all. Ramzan, I know you've been looking at some of Antoni's past commentary. We were talking about this a little bit in the last hour, that he's been a critic, but it's not clear how he would fix it, right? Or how he would change it at this point.
That's right. I mean, it's clear he's a Trump ally. You don't have to be a genius to work that out. He has called the data from the BLS back in May. He tweeted and said on X, he wrote, it's like getting a random number generator. He's called the CPI data under Biden phony baloney. So he's clearly, agrees with President Trump on a lot of things. And that's what the worry is, that the Senate he does need Senate approval. And his critics are worried, though, that he's not going to be neutral enough. And don't forget, non-farm payroll data is often revised. And in fact, in the run-up to the November 2024 elections, the big revisions, some economists and statisticians would tell you they hurt Trump's opponents more than they hurt President Trump. So it's a really tricky one. He's definitely going to get grilled by Democrats, but don't rule out any Republicans also asking him some tough questions as well. Don't forget the number of staff he's going to be in charge of is just 2,000. It's not a lot, and we're in a period where President Trump is trying to cut jobs in big agencies. So this is going to be a tricky job, whoever took the job. But he's going to come under increased scrutiny as he's seen as sort of a big Trump ally as well.
Right. And economists have been calling for more resources at that agency, not less. Brooke, let's turn to this new China trade extension. It was expected to happen, but they waited till last moment in order to extend it here. We know that the discussions are ongoing. And so the market has seemed to sort of take it in stride. Just, maybe with the exception of some pockets.
Yeah, certainly some pockets indeed. And what we saw this week was that pocket carved around NVIDIA and AMD now saying that 15% of their revenue that they make from these chips to China will be given, back to the U.S. government. And so there's some carve outs here that really sort of excited the market heading into this trading week. But after we did get some reports, some murmurs of this 90-day extension, we did see Monday's trading session hit new session lows around 2:30 yesterday afternoon, as investors, now have to wrap their head around the fact that we are now not going to get some final, maybe, deals, or rather numbers of exactly what this tariff could look like until November. And so it's ultimately yet again this wait and see game that has been going on quite literally since April that investors are a bit fearful for. And that's what we saw in yesterday's market session that led to session lows at the end in the last hour. And so now what we're seeing, of course, is this rise back up into futures based on the CPI print. But investors, what I'm hearing from sources this morning, are largely still focused and are waiting to see what that ultimate trade deal will be at the end of the day, ultimately with those carve-outs attached.
And Ramzan, what about internationally? Are we seeing any kind of ripples in the market as a result of the latest headlines?
So the initial reaction in Europe in early trade was pretty subdued. In fact, markets were pretty mixed. They've actually turned pretty positive after that CPI print. In Asia, though, Japan was closed for a holiday on Monday. They certainly made up for it today. Japan, Nikkei up over 2%, hit another record high. The markets in China, the Shanghai Composite, also up as well. So even though mainly I think the markets had priced in that this extension was coming, there has been some positive reaction, certainly in Asia. And it's really interesting to note that quite a lot of the big tech names in Asia across the board have risen. For example, Semiconductor Manufacturing International, it's a Chinese chip maker, that was up over 5% in Hong Kong. Advantest, a big Japanese chip maker as well, up over 6% as well. So there are some, clearly some big winners from that trade extension that was agreed.
Brooke, Jennifer, Ramzan, thank you so much. Appreciate it. Shares of stablecoin issuer Circle, they are jumping by 13% this morning after they released the first earnings report since Circle's blockbuster IPO a couple of months ago. Yahoo Finance senior reporter Ines Frey joins us now with the details. And the company saw pretty big double-digit increases in its revenue.
Yeah, that's right. Its revenue jumping 53% year over year to $658 million. That's revenue and reserve income as well. The company also highlighting USDC, that's their stable coin, in circulation grew 90% year over year. And that also grew through August 10th of 2025. So you really have this growth in their circulation of stable coins. They also talked about transaction volumes growing as well, accelerating into Q3. That's a total value of USDC transactions that are conducted. And then they also highlighted the launch in May of their payments network. That's for financial institutions. They have more than 100 institutions that are in the pipeline for that. But I think that the big headline here was this announcement that they made about ARC. This is a new blockchain network that will be launching in the second half of this year. And it is compatible with the Ethereum infrastructure, but it will be a standalone network and it will be for stablecoin finance. So it's going to be for stablecoin payments, for FX, and also for capital markets. I think that that's what the street is very much bullish on. And that's why you're seeing the stock up, as well as the revenue beat, the increased circulation. Something interesting on the call as well, that they said that they were not going to be giving quarterly guidance, but provide guidance for on a full year basis. But certainly, listening on that conference call, analysts seem to be pleased with the results, that they were congratulating management on the successful IPO that they had in early June and the successful quarter as well. The stock right now is up more than 480% since that IPO, since they went public on June 5th. And I will say that you have a mix here of 9 buys, 5 hold, and 4 sell. But certainly this morning, investors seem to be pleased with these results.
Yes, definitely so. Thanks a lot, Ines. Appreciate it. And we'll have more coverage of Circle's earnings. I'll be speaking with Jeremy Allaire, Circle co-founder and CEO. That's coming up on Market Catalyst at 11:50 a.m. Eastern. You don't want to miss that. And coming up next, we're going to catch you down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's trending tickers. We are watching Hanesbrands, Cardinal Health, and Archer Aviation. First up, Hanesbrands shares jumping today amid reports that Canada's Gildan Activewear is in advanced talks to buy the U.S. underwear maker. That's according to the Financial Times. The transaction could value Hanesbrands at almost $5 billion, including debt, and it might be agreed by the end of the week. The FT is reporting that the negotiations are not finalized and could still collapse. Last week, Hanesbrands posted better than expected results in its second quarter while lifting its forecast for the year, citing better visibility over costs. Next up, we've got Cardinal Health, the healthcare supply chain firm, reporting adjusted operating income for the fourth quarter that fell short of Wall Street's estimates. Shares are falling after that metric clocked in at $719 million, below the estimate of $730 million. The company also announcing an agreement to purchase Solaris Health in a $1.9 billion deal. That's the company's latest acquisition in the urology category and expansion of its multi-specialty strategy. Year to date, the stock has gained by 33% as of Monday's closed. And finally, Archer Aviation falling after reporting a greater than expected loss in the second quarter. Now, the air taxi company also posting operating expenses higher than Wall Street was expecting. Archer doesn't generate sales yet, so the company spent a little more money than expected developing what it calls eVTOL, electric vertical takeoff and landing aircraft that can be used to ferry passengers quietly on short trips. Cantor Fitzgerald analyst Andres Shepard was encouraged by the quarter and management's plan to ramp up aircraft production. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Gold markets breathing a sigh of relief after President Trump confirmed the precious metal would not be subject to tariffs, ending days with speculation that bullion could be caught up in trade war tensions. Joining me now, Dennis Gartman, former editor and publisher of the Gartman Letter. Dennis, it's good to see you. We know that you have been cutting your gold holdings. You said you sold more than 80% of your gold holdings last week. How are you viewing what we've seen thus far this year and sort of these latest tariff back and forth developments?
The idea of tariffs caused a great deal of confusion. Markets rallied $50, then fell $50 in the course of a few hours. That's enough to make me go to the sidelines. I don't like that kind of volatility. I abhor that type of volatility, and I'd rather be on the sidelines watching. So yes, I've sold almost all of my gold. I've been bullish of gold for many years. As the chairman of the university, the emeritus chairman of the University of Akron's endowment, I had us buy 5% of our portfolio in gold 3 years ago. But when we have our meeting next week, I'm going to suggest lightening up just a tad on that. The market had anticipated a great good deal of geopolitical circumstances that were going to be ugly, and I think that the geopolitical circumstances are getting less troublesome and less dramatic. Also, the concept of tariffs being terribly inflationary, tariffs are actually deflationary in the long run. They are a one-off inflationary circumstance, but unless the monetary authorities move to monetize the rise in tariffs, and they have not done so yet, tariffs are actually deflationary in the end. So I think going to the sidelines in gold has been a reasonable decision in the past 2 or 3 days. We'll see if it continues for the next several months.
Dennis, I want to unpack what you were saying about tariffs being deflationary a little bit more. Can you explain that a little bit further?
Yes, as long as the monetary authorities do not monetize the increase in tariffs, tariffs are a one-off circumstance. They raise prices one time only, and then you have to have the monetary authorities come in and monetize, be more aggressive in their monetization process. They have been curtailing the size of the balance sheet from $9 trillion to around $6 trillion. And unless the monetary authorities come in and begin to buy QE again or affect QE one more time, the effect of tariffs is just a one-off circumstance, and it's a debatable circumstance. But right now, I think it's in the long run, it tends to be deflationary unless the monetary authorities come in and monetize. You have a one-off event on the upside, and there's not enough money to buy to keep that process moving forward. So I think in the long run, tariffs, as long as it's just a one-off circumstance, are deflationary, not inflationary.
So you're just saying because of simple math. In other words,
yes.
Because tariffs push up prices, and then if you look a year out, you will not see those price increases persist.
That's correct.
And therefore,
that's absolutely correct, Julie.
Okay. I mean, I guess the concern is that they'll make their way through the system, be more persistent, and unanchor inflation expectations, right? And that could have a persistent inflationary effect.
I will not take exception to that. That's correct. But again, I will watch what the monetary authorities are doing, and as long as they don't increase the size of their balance sheet and erupt another round of quantitative easing, tariffs are deflationary in the long run. So time shall tell.
It doesn't look like that's going to happen right now, but I will ask if you think that given today's consumer inflation data, does that point to where the markets are, which is the Fed cutting in September?
The Fed will cut in September. There's no question about that. I shouldn't say there's no question, but there's very few questions about that. They've set it up without question to have a cut of at least once in September, maybe once in the final 2 or 3 meetings of the year. But I think there's no question that the Fed will allow the Fed funds rate to decline a tad at the September meeting. No question about that.
Do you not, the Fed has been, though, pretty cognizant or sensitive to the idea that inflation could be making its way through from the tariffs and could potentially be persistent. Do you not think that a 3.1% rise in core inflation year over year is something that would make them again say there's no risk in waiting?
If you started to see 3.5, 3.6, 3.7% later in the year, then the Fed would moderate its stance, and the idea of having two more eases in the Fed funds rate would be thrown out the window. But the odds of that happening, I think, are relatively minimal. Take a look at what's going on in the grain market, for example. Take a look at what's going on in the cotton market, for example. Take a look at what's going on in the energy markets, for example. There are deflationary pressures there, not inflationary pressures, and I don't think enough people are paying attention to that fact.
Well, we'll be continuing to watch it, Dennis. Thank you so much. Good to get some time with you.
Good to see you. Thank you, Julie.
Coming up on Yahoo Finance, opening big. Our executive editor, Brian Sozzi, joins me now with a little preview, little taste of what's coming up. What's coming up, Soz?
Yeah, fired up, Julie. Now, don't get me wrong, very excited about the CPI print, the market reaction, what it may mean to interest rates, but I'm feeling stocks this morning, Julie. We're going to dive into CoreWeave ahead of its closely watched earnings after the close. And then on Intel. Intel's getting a pop here, pre-market. I'm here to say it's probably not deserved. Really fundamentally flawed company.
All right. I look forward to that.
You should.
Controversial takes on the part of Brian Soz, or maybe not that controversial. I don't know. We'll debate it. That does it for Morning Brief. Thanks, Soz. What for ahead on Yahoo Finance?